We are getting whipsawed by the news coming out of the Middle East and out of Washington. And in addition to all of that, many commodities have been getting whipsawed as well. And we're going to talk about that and maybe elaborate a little bit more on the things I was talking about yesterday with Chewy today on Office Hours with Professor Mark Guthner of Rutgers. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guthner of Rutgers. How are you, Mark?
Very good. How are you, Mike?
Good. You guys are going on spring break next week, is that right? Did I see that on the calendar?
We all need it.
So I'm going to assume we won't be having office hours next week so that you can enjoy your holiday.
We can do it. We can do it. I'll be either here in my office or at home. I don't know where, because I don't know if my son will be in school or not. If he's in school, I'll be here in the office. If not, I'll be at home. But we'll do it.
Very good. Okay.
I'm not going anywhere. No spring break for me.
Oh, that's too bad.
I mean,
you're gonna be grading,
no trip to Florida,
stuff.
I should say.
So, it's been a pretty wild week since you and I last spoke. I mean, news is coming at us fast and furious these days, it would seem. Some of the volatility that we saw in commodities over the weekend was quite extraordinary. Ranks right up there with some of the more violent moves I've seen. West Texas got up to, I think, 119.46 in the overnight on Sunday.
Yeah, that was.
And then fell back, and now it's down.
High 70s, I think.
Yeah, I mean this is just a remarkable swing. No, I don't think so. I think it is in the 70s. Oh no, it's 81 bucks now, but it did get into the 70s
just earlier today. Yeah.
Yeah. So if we just take a quick peek at this in terms of the moves, we saw a decline of 36% over just under 38 hours.
Wow.
So 1% per hour. That's those are big moves.
It is. It's surprising we didn't read about somebody going bust.
It's possible, I suppose. Well, it is possible that because this first move happened over the weekend.
Oh, they didn't. People didn't have a chance to screw themselves.
Yeah, that is certainly one possibility. Yeah. There is another thing, which is that it is also possible that somebody did go bust, but we either haven't heard about it yet or won't.
Yeah.
So what some people may not know, and I'll just give a little bit of background on this, is that there are a lot of trading firms that are not necessarily trading on their own balance sheet. Let me explain how that works. So, when I was in the business in the late 90s and early aughts on the prop trading side, our trading firm was members of the exchanges where we traded, and there were 4 at the time listed equity options exchanges. And then when I switched to another firm, we had more exchange memberships because we also traded futures. So we had operations on the CME. We had operations on the NYMEX. We were members of these exchanges, but we were not clearing members. We were not self-clearing. That's not terribly uncommon that you have trading member firms, that is, that they are members of the relevant exchanges and that they trade the underlying products, but they clear their business through another firm. So the first trading firm I worked for, we cleared through a firm called Spear, Leeds & Kellogg. Spear, Leeds & Kellogg they were market makers, they were specialists, they were a clearing firm, they had an execution platform, and ultimately Spear, Leeds & Specialists, probably what they were maybe best known for on a multitude of exchanges, they were ultimately acquired by Goldman Sachs. So initially we cleared Spear, and then we cleared Goldman Sachs. So there were 2 clearing member numbers for Goldman Sachs. Now, there was another trading firm down there, which I'm not going to bother to mention who they were, but they were sizable. They traded quite a lot. And they had exposure to a few stocks that had some very big swings, and their lead specialist was a guy who was not afraid to take substantial risk, and they lost quite a lot of money, and in fact got upside down. So if you can imagine, it's the trading firm's capital that is deposited at the bank, and the best way to think about it is that their first loss, right? So you take risk, and you have all of these positions on, and you lose $10 million, and that comes basically out of the trading firm's capital base. But because you're trading on the bank's balance sheet, it is possible that you could wipe out the trading firm's capital, and essentially now the risk is essentially, if everything was unwound, that risk gets absorbed by the bank itself. And in this particular instance that I'm referring to, and I'm not going to, again, mention the name of the firm because, that I got to just sort of out people in this way. But that firm actually did get upside down. I can't remember what the amount was, but somebody told me that they got upside down by like 40, 50 million bucks. And the determination was made at the clearing firm that they were going to let them keep going. They weren't going to force them to liquidate their positions. And they let them trade the bank's capital effectively. The rationale for this was twofold. One is that they had had a long pre-existing relationship with that trading firm, and that trading firm had been profitable. Secondly, they viewed the events as exogenous and idiosyncratic. That is to say that when they evaluated where the money was lost, the name in which it was lost, that it was a series or a confluence of extraordinary events that caused it. And finally, the firm had tons of traders, huge numbers of positions, members of multiple exchanges. And in the bank's assessment, they felt that they were probably, even if they wanted to unwind everything, the people who managed those positions were probably the best positioned to do it. And so they said, you guys keep doing what you're doing. We're just going to watch what you're doing very carefully. And they worked their way out. They ended up returning to profitability. They made the money back and then some. And ultimately, that firm ended up being sold to another big trading firm for about $500 million. So went from being a big trading firm to having negative equity to being sold for $500 million. It was an international company that bought them, by the way. And people are going to start to figure out who I'm talking about probably if they really do their homework. The international company, European firm that bought them, ultimately went bankrupt. So that was many, many years later. But so anyway, it is possible as we look at what happened that there were traders who, took some significant pain. It's not necessarily true that we're going to know all about it if they did, though.
Yeah.
Because there are things like that. But you were actually, as wild as the moves in crude were, you were actually looking at silver. What are your thoughts there?
Well, I was looking at silver because I saw implied volatility up over 100, which is unheard of for silver. It typically trades at an I vol of about 25-ish, maybe 30 on the high side. It really ripped higher, as you can see from the chart you just tossed up there. Realized vol was as high as 141, which is really quite remarkable. But the thought that I was having today before the podcast was that, people were focusing on gold and silver there for a while. And, there were rumors that inventory is being taken off the exchanges. And so there might be some difficulty in making delivery at some point and things like that. Now, these things always come up. These claims come up. Well, it seems like they've come up my entire life every time there's a big rally in gold and silver. But what I think is interesting is that all of a sudden the world's focus has changed, and maybe people are taking their focus off of silver because on another commodity, they're looking at um, oil. And down the road, they might look at natural gas because natural gas, a lot of LNG goes through the Straits of Hormuz, not just oil. And I was starting to wonder if whether or not, and that's what I wanted to talk about today, if it makes sense to maybe fade volatility in oil for a while, in silver for a while, because it's at least for the moment fallen off people's radar screen.
Yeah, I think that's an interesting idea. So, I'll bring one quick thing up about natural gas for anybody who's suddenly tempted. Natural gas, much more so than crude, is a local commodity, and that is because it is not as easy to transport as crude is. The way that we would transport it,
Mm-hmm.
if and as and where we do, is via liquefied natural gas. So that's going to be on the domestic side. You're thinking now about companies like Cheniere, appropriately ticker LNG and so on, which I'll actually pull up here. But the price for natural gas domestically and in Europe, for example, can be very, very different
Mm-hmm. Oh yeah.
as a result of basically the challenges in transporting a lot of it. You need to have specialized tankers. You have specialized ports, LNG terminals. So it's one thing to produce natural gas in Texas and then via pipelines transport it around North America. It is quite a different thing to get it to Europe because there are no pipelines. So it is going to be an issue. I mean, we do have LNG terminals. You can't necessarily scale. I mean, building a new LNG terminal is not an instant thing in the first place. So, how quickly domestic players might be able to respond to a big spike in international demand. It's not entirely clear. And by the way, this is not the first time we've had this, right? So people are talking about the fact that 20-25% of the LNG consumption globally goes through the Strait of Hormuz. But we've already had a massive disruption in natural gas markets globally with the Nord Stream pipeline.
Yeah.
Right? So Europe gets considerable amounts of natural gas from Russia via the Nord Stream pipeline, and the Ukrainians, with or without potentially support from any of their allies opposed to Russia, blew it up. So that was a huge disruption. It was also a big environmental disaster, but that's a separate issue. I do think what you're talking about in silver is an interesting situation. And here's a chart that I think might give some thought to this. So the first thing I want to say is that if you're going to short volatility in silver, it is very possible for short-term volatility in silver to remain quite elevated. As you point out, the 30-day realized volatility, that's this orange line right here, is almost 140. And let's go back. We'll take a look at 10 years worth of data and see just how often that happens. How about it doesn't happen? The last 10 years, you haven't seen anything like this. That's where we are now. So we have had some big spikes in volatility, but nothing like this.
Yeah.
Look at what happened in the pandemic. We had a huge spike in precious metal volatility, and 30-day realized in silver got to about 65. Later that year, it got into the mid-high 70s. Now it's double that. Well, the interesting thing about selling volatility is that notice that what we have here is that the realized volatility in orange vastly exceeds the implied volatility. This is 1 month implied volatility. That's in white. So the challenge, if you're going to sell vol in something like silver in this kind of an environment, is that because things are whipping around so wildly, and I'll just bring the price in so we can see this, and let me get rid of some of these other things. So this is just the price now. when you get that kind of a move, if you short dated premium, that's going to be a challenge. So my thinking, and you can tell me whether you agree with this or not, is that if you're going to short vol, it's probably longer dated vol that you want to short. So if we take a look at, say, 18-month implied volatility, again, I'm going to get rid of the price so we can just look at this now.
Yeah.
That's also about 60, okay? That and 60, give or take, is double the mean and about as high as it has ever gotten, right?
Yeah.
So you're selling it, that's basically getting short vol here and here, and you can stomach a lot more pain in basically the short-term volatility if you're short long-term options. How do you think you would be interested in positioning that if you were going to put on a trade? Something like a long-term buy, right? If someone doesn't want to start trading vol itself, like selling straddles or strangles, something like that.
You could do that. I don't know if an iron condor would make sense, but I'd have to play with some different structures and kind of see what the payoff looks like.
Well, let's do that now. So I'll pull up SLV here. So just for other people to think about how we might do something like that, we might have just sold. Well, first of all, when we were on the market making side, any bid you would just hit it, right, and then hedge it dynamically. So whether it calls, puts, or maybe you would initiate by selling straddles, strangles. Another possibility would be that you could try to have a little bit of more consistent Vega exposure, which means that you would sell perhaps a strip of options. So sell some out-of-the-money downside puts and some out-of-the-money calls, and just have them sort of laddered across a couple different strikes, just so that your Vega exposure is relatively constant. That would mean you would need to sell more of the lower strikes because Vega is a function of the strike and the price of the underlying. So if you wanted it to look kind of like synthetic variance or something like that, it would have to be slightly more of the downside strike. So you would be weighted. One way if people are interested in sort of thinking about how that math works, I encourage you to go to the SIBO website. They have a white paper on the VIX, and that sort of goes over that whole notion, like how you create relatively flat vol. Okay, so to put things in perspective, let's just imagine. So we're at 80 now. If you sold a June 2027 straddle, it's 50% of the current price of silver.
Wow.
So you collect over $40 for that. So your break-evens then would be
$40
less than 40 on the downside and more than 120 on the upside.
Yeah.
Which is a pretty wide range.
It's hard to see how it could be above 120 18 months from now.
Well, so if you're now, you can just sell something like that naked and hope.
Yeah.
Or if you're selling vol, what you would do actually is you would sell that structure and then keep track of how many deltas you had, because this is a fairly delta neutral trade right here. So let's
and
so
their term is delta neutral.
Yeah, and actually this is well, I need to I actually should choose a slightly higher strike because the forward price for silver has to embed the cost of carry. So it's actually going to be slightly higher than 80. So let's choose, well, let's just figure this out. So what do we want to use as a risk-free rate? Like 4%, 4.5%? No, 4%. So this is a year and a half. We'll call it 6. So what it's moving around even as we speak, we'll just say 6% over 8. So that's like 84, 85-ish. So because this is more than a year away. This is
it's
a
about
year and a half.
$5.
Yeah, so we'll just go like that. We'll use the 85s. And you'll notice actually, or the 84s, you can kind of see this because SLV, of course, doesn't pay a dividend. You will notice when you're trying to figure out approximately where the forward is, that you're going to notice that the price of the call and the put at the forward is going to be very close
Almost
to
the same,
each
yeah.
other. So you'll notice here that the call in this case is 21 bucks and the put is 22. So maybe it's a little lower. If I go to this, these are mid prices too. So yeah, maybe 83-ish.
Okay.
Yeah. So then you end up with something that looks like that. So that's kind of where the implied is. And you end up with these types of break evens. So if you just did that, you would be long on the downside. You'd be getting long at 38. And you'd be short on the upside at 125, right?
Yeah.
125 and a half. Or 40. Oh, actually, it's written out for me over here. So that's more precise. So $40 on the downside and $125.50 on the upside. That actually doesn't... that doesn't seem so bad,
yeah.
actually. That seems like a pretty wide set of break-evens. This is actually really not quite a year and a half, actually. That's one of the reasons why the strike was a little bit lower, because I have to remind myself, the clock just sprang forward. We're actually in March already.
Yeah.
So this is really only about 15 months from today. But one of the things that people can do if you put on a trade like this is if your deltas get too out of whack, you can start to hedge. Let me give you an example. Let's say you put this position on and silver starts to creep up. And then it starts to creep up a little more.
Mhm.
And it creeps up a little bit more. And the next thing you know, SLV is trading $100. And you're sitting there thinking, well, my upside break even at this point is, just over $25 away. And if this thing just takes off, then I'm going to be net short silver at that level. Well, what you could do is you can buy a little of SLV so that you get back to delta neutral. And if it drifts back in, you can start to sell it off. So you're short convexity. But the good news is with long-dated options, the deltas are not going to swing around that much. Short-dated options, if you sold a straddle that expires in a week or two, and SLV moves by 10, 15 bucks, your deltas are going to swing around a lot.
Yeah. There's a big
You sell
kink
an option
there.
that expires 15 months from now. It won't. The other thing you can do, and I have done this in other contexts, in fact, I don't even mind telling folks what the security was. In Philip Morris, I had a position not unlike this many, many years ago. So before the tobacco companies had they worked out a settlement, essentially. We had a very pronounced high implied volatility across the surface. But what we recognized was that there was probably going to be one wild day, one wild move, and then something would happen. You're nodding off there, Mark.
Yes, I am. I am a little tired today.
And so that's what we did: is we sold some long dated premium and bought some short dated gamma. I got another question for you. This comes up from yesterday, and I started to talk to you about this a little bit. What do you think of Chewy here? They have had a number of secondaries, but I don't see any reason why they need to do another. They have positive free cash flow now. They've got earnings coming up on the 25th. I talked about this a little bit on the open mic session yesterday.
Yeah.
What do you think?
Chewy's kind of an interesting company because, well, for one, I notice it in my building. There's a lot of people get Chewy delivered to my building. Seems like there's a box there every couple of weeks of food and toys. So people like, at least anecdotally, my neighbors like to have things delivered to the building. And they've turned profitable. And there seems to be nice momentum in the growth of free cash flow. So the question is do you want to pay, what is it, 50 times earnings for a company that's growing revenues at about 15%, 14%, I think, over the last 5 years on average? So the stock, now what's interesting is that while revenues are growing at like 15%, free cash flow is growing much, much faster. So
Mm-hmm.
they've kind of done their build out, and so now they need less capex to deliver on their value proposition. So I don't know what their I was looking at this earlier on another platform, what their free cash flow growth looks like. Let me go see if I can.
So the forecast year on year. So they're going to be on the 25th. They're going to be reporting fiscal year 2026, which ended January 31st of this year. The street's estimate is about 585 million versus 487 the year prior. That's 20% year-on-year free cash flow growth, and if achieved, that means that their trailing free cash flow yield versus EV is going to be about 5.5%.
Yeah.
The street's expectation for forward free cash flow growth is also, well, it's a little bit less, but it's in the neighborhood of 18-19%.
Mm-hmm.
And the way I was looking at this was, we'll remember that Amazon traded, at a nosebleed multiple on a trailing basis, and actually even on a forward-looking basis for many, many years. And the reason it did so, and what a lot of bulls in Amazon, to their credit, would say, is they would say, look, the company is building out, right? They are still in growth mode. You should not be looking at adjusted earnings. You should be looking at EBITDA or some other equivalent. And so they always looked at the valuation of Amazon on an EBITDA basis. And if you do that here, then things look a whole lot different. You start to say, well, all right, well, and that's why I was looking at free cash flow yield. That's, to me, free cash flow yield is, cash flow is, it's number one, it's hard to fake. and number two, it gives you significant flexibility. And one of the criticisms for Chewy in the past, and a viewer actually brought this up, was that they didn't like the fact that they kept doing secondaries. And they've had a couple, like over the course of the last few years. But I don't see any. They have net cash now, and they have it seems like they have good free cash flow. So I don't really see why they would need to do any more of that. I'm just going to quickly do this. I'm going to put in the M&A.
So they got 675 million of cash, another 20, call it 700 with short-term investments.
Mm-hmm.
They got long-term debt of 565. Let's see, short-term. Do they have any short-term debt? I don't think they have any short-term debt. So they are net cash positive. They're clearly free cash flow positive. So yeah, there's going to be no reason for them to come to the market again to raise money. They're finished. They're finished with that.
Yeah. In fact, I thought I saw a note from Morgan Stanley that indicated they were even talking about if and when the company might begin to do buybacks. Because, if you have a 6.7% free cash flow yield, which is what the street's estimate is looking ahead, then indeed you do have sufficient free cash flow to return some to shareholders. So I thought that was kind of interesting. Let me just take a look. I just want to see what their CapEx numbers were and whether there's... So these free cash flow numbers do not even call for or estimate a huge decline or really any decline in CapEx. In fact,
I don't know why their
CapEx is actually going to be going up.
Yeah.
I guess the reason is that I never like it when I start seeing like, oh, they're going to suddenly start having tons of free cash flow, and one of the reasons they're going to have free cash flow is because they bought everything they ever needed to buy. And, stuff depreciates, it breaks down, you need new plant, equipment, this, that, the other thing. So I don't like to see free cash flow coming from estimates that there will never be any CapEx anymore. But that's not the case.
Well, CapEx should generally be at least as large as depreciation. That's sort of rule of thumb if you're trying to maintain a business. You typically have to have a little bit more than that to deal with replacement costs, which are going to be higher and stuff like that. I'm not sure why analysts are looking for there to be a growth in free cash flow. I mean, in CapEx. That doesn't. I don't know enough about the company. Do they have something teed up that they gotta pay for?
I mean, yeah, it's funny. I mean, we're looking at these capex and we're thinking like, oh my goodness, capex is going to grow by 30-40 million dollars. And you look at Microsoft, and over the last 3 years, it's grown by $70 billion.
Well, yeah, that's
So
fine.
they're not building mega data centers. We know that
Yeah,
much. Whatever it
that's
is.
not. It's just that
Um,
it's so different from the past. They were pretty consistent in the past that their capex were about 180, 140, $180,000, right around there. Um,
I would guess. I mean, to me, where this would make some sense is that if you take a look, so from 2023 to the end of 2025, um, we saw over a 2-year span an 18% increase in revenues. Some of that probably inflation related. Inflation has slowed. We're looking at least comparable revenue growth estimates. That would suggest to me possibly more real sales.
yeah,
And if you're doing more units, you need to be able to accommodate that. So that would at least justify a portion of it from my perspective. This is thumb in the wind kind of
yeah,
stuff. Like, how can I look at those numbers and make some sense of them? But that is a way that makes some sense to me. That a simple way to think about it: you're in the widget business, and if I sell $100 million worth of widgets in year one, and year three I'm selling $120 million worth of widgets, but we had an increase in price of 20 million, we're still pushing out the same number of widgets. The requirement in the respective plant, equipment, logistics, warehouses, trucks, whatever it is, hasn't really increased other than your need to invest in to handle depreciation. On the other hand, if you have a similar level of anticipated revenue growth, but the inflation is only going to be 5%, well, that means that 15% of that is actually going to be coming from additional sales and real growth, if you will. And that's going to require more bodies, more little robots and forklifts and more widgets, basically,
yeah.
right?
They had
So,
quite an increase in capex once the lockdown came about, and that makes sense because all of a sudden you're
mm,
not going to the pet store. You're going to
yeah.
get that all delivered, and now people are in the habit of having it done that way because those 50-pound bags of dog food weigh 50 pounds, and that's not fun to carry those things around. So
I mean, look, I don't think the trend of people getting more stuff delivered to their house is going anywhere.
people like
And
convenience.
yeah, I mean, we get things delivered from Costco fairly routinely now. That was never a thing before the pandemic. I don't I don't know that we ever ordered anything online from Costco. We still go to Costco regularly. I was horrified when I figured out last week that both my wife and I went. One of our sons convinced me to go early in the week, and then a couple days later, he convinced her to go. And I was thinking, my God, I mean,
Uh-oh.
we both dropped $700 at
Oh my
Costco.
goodness.
Yeah. Well, I mean, when you have two teenagers that they'll each out of house and home, and of course, if I go to Costco and he tries to stick something into the big basket, and I'm like, no, that's not going to happen. Then he needs to get her to go. Maybe she won't
Yeah,
notice.
to fill it in. That's pretty, we are very judicious when we go there because it is so easy to spend a ton of money, and we constantly ask, can we buy it now? Can we put this off till next week? That's always the question we ask.
It's
Can
shocking.
we wait till next week? And then that helps us avoid making some purchases altogether because um, we forget about it. Anyway,
So
let's go back to
I
Chewy. Um,
yeah.
so it's a turn. I think people love their animals and they like to take care of their animals. They like to buy them toys. They like to play with them. For some people, it's like having a kid. Um, and And during normal times or even a little bit hard times, people continue to spend on their pets. They get a lot of enjoyment of, buying stuff for the pets. The pets always respond so positively when you throw them a new bone or something like that, a rawhide bone
Mm-hmm.
or something to eat. So that's always um, that's fine. So I think you were mentioning earlier today, you kind of think of them as a staple. I think of them as a staple with maybe a fat tail because people
Mm-hmm.
did during the financial crisis really panic, and then there was a lot of stories of people dropping their pets off at shelters and things like that during the financial
Mm-hmm.
crisis. Um, but since I don't expect anything like that to be happening in the near future, um, and even if we got to slow down and let's say zero GDP for a while, I don't think that really hurts Chewy.
So we have a question here, which I think we ought to pose to you, and I can understand why folks are looking at this kind of situation with what's going on in the Middle East. You and I haven't talked that much about it today. Um, since the last time we spoke, Iran has selected a new leader.
Yeah.
One of the four sons of the prior leader, Khamenei, is taking over. Some have suggested that he's a hardliner, um, even on a relative basis, because I think most would probably suggest that the Iranian regime was pretty much all hardliners to begin with. What we're seeing, though, of course, because of this, is some increased uncertainty about whether or not the comments that the president made yesterday, talking about the kind of, I'm paraphrasing, but basically sort of a light at the end of the tunnel where we can sort of see this thing potentially coming to an end right soon. And now there seems to be a lot of people pushing back on that. One of the reasons is that the spokespeople for the Iranian government have uh, pretty much rejected that notion. They said, we're not prepared for diplomatic talks. Instead, we are prepared to continue the fight.
Yeah.
The other is that the new leader, in addition to his father being killed, I believe two other family members were as well. I thought I saw it reported that one of his children and perhaps his spouse were killed in strikes. That would suggest that some measure of intractability on diplomatic relations, because I can't speak to this individual's state of mind, but it's not difficult to imagine that they wouldn't be prepared to negotiate. So that being the case, that would suggest that things could be more prolonged than was being suggested even within the last 36 hours. So the question that we're getting is, how would you advise setting up triple Q hedges using bear put spreads? Buy 90 days to expiration, roll every 30 days to keep some value in the trade, or just hold until maturity and write off the cost of the hedge. So I'll ask you, what are your thoughts on that first and foremost?
So I would say first off, it sounds like he's got an existing position and he wants to hedge that position. That's what it sounds like he wants to do. And I think 90 days or perhaps is okay. I don't think you need to go longer than that. And you might give yourself a tail. Like, I don't know, did he mention in there a width, or did he just said a put spread?
He did not. I think.
But I would give it some width because there is a possibility that if something goes horribly wrong, that we sort of gap down, and that's what you want
Yeah,
to protect yourself from.
Yeah, I think that's the first thing, is that a hedge should be, I'm going to just use, well, let's go out to June. So June is 100 days. May is 80. Let me offer just a couple things to think about. And part of it's actually related to what we were talking about in silver before, which is that the further out in time you go, the less gamma the options that you hold will have. And that can be a positive. It could also be a negative. What it means is that there's just going to be a little bit less convexity to it in the short term. If you use longer dated spreads, those spreads are going to preserve some extrinsic value. And that means that they might not give you quite the bang for the buck that you think.
Yeah.
So I'd like for people to think about two different ways to hedge and ways to think about managing them. So the first is, let's just imagine, and I believe Goldman Sachs put a paper out on this, maybe someone can find it, that the best short-term hedge would be something like a 30-day 30 delta put as a form of, sort of disaster insurance. So I'll go out 30 days, and I'm going to look at the Qs right now and see what that 30 delta put might be. And that would actually be, now in a high volatility environment, it's going to be close to the 590s. So,
Yep.
So that's going to be, I'm just going to use 610. So that's about 3.3% out of the money. And that costs $9.85, which is, we'll call it 609. That's about 1.6% of the value of the underlying ETF. If you put a trade like that on, I do not believe in just buying it and holding it to expiration. Rather, I believe that what you should do is you should take some money if you make some money on the hedge. Because, here's a different way to think about it, which is if you're investing for the next 10 years or 20 years, do you believe that the NASDAQ is going to be higher than it is today? I think most of us would say we believe it's going to be higher than it is today. I also think that there will be a period between now and then when it is lower than it is today. Mm-hmm. But if I'm not going to sell the underlying, and I don't intend to monetize my hedge, why am I buying the hedge at all?
Yeah.
There wouldn't be much reason to do it. In other words, you hedge so that you can monetize it. There is another reason why you might, and that is just strict risk management, which is to say, at a bank, you have a risk manager who's saying you can only take a certain amount of risk. That's it. So if you want to have a certain amount of long exposure, you have to have a hedge on so that you can't take a certain loss.
Yeah.
So how do you do that? Well, if you bought this put and let's say it doubles in value, okay, which means in the short term, what would doubling in value mean? It means you're talking about the thing, becoming, call it a 60 delta option, right? So the 60 delta put's probably about double the price of that. Yeah, see? Mm-hmm. So, and that actually, to me, is something I've talked about in the past, which is that if I'm long an option and it gets to 60 delta, I'm always looking to roll it or to hedge it or to monetize it, because by the time it gets to 60 delta, it's behaving more like the underlying stock, right?
Yeah.
It's the whole benefit of being long options is to have that convexity. So why would you, maintain it? So think about rolling at that point. Roll it down to another 30 delta put. What would happen if this took place? So if you bought that 30 delta put and it goes up to 60 delta or thereabouts, it's probably going to be about double the price you paid. If you roll back down to the 30, you're essentially going to have all of your capital back out. So that's
an idea. Why don't
that's one, yeah. If you're going to do a spread, you can still monetize it, and also, but just bear in mind that if you have a 90 delta spread, let's just say for the sake of argument you bought this put, but you went out further in time. So buying the 590s, but I'm going to go out to 90 days to expiration, or 80. That is now a 34 delta option, and maybe I'm going to sell. Let's see if we can sell maybe a 20 delta put in this case. All right, so the 20 delta puts would be something like, well, I'll go down to the 550s. Okay. Now you're getting $40. I don't know if that's enough of a hedge for you, but you're going to spend a little bit less money to get that option, that trade on. Now you have a trade that is, in this case, about 20 deltas, give or take, maybe a little less. Actually, it's closer to 15.
4,000.
Yeah. So I guess it goes a little bit to what you think. Is this going to be a long, drawn out thing? And is the market going to be in rolling over in sort of a prolonged fashion? In other words, we're pivoting from a bull to a bear market. Then I like the put spread better. But if I'm really concerned about, the latest shocking news, I think trading trading like a 30 delta long put in an index and hedging it dynamically might be a better way to go. I've actually even sometimes just put strangles on. I've talked about that. I bought 30-day SPX strangles and then just hedged the delta of the strangle and had it as like a long vol bet. The idea being that if the market really just took a digger one day, I'm gonna capitalize on the jump risk, right? And the rest of the time I'm just mitigating the decay of holding it. And maybe I'd get long 45 days out and never just ride it all the way in. But that's something to think about.
What do you think about a put calendar? So maybe we look at a 585 strike or 580 strike, and maybe we talk about 120 days on the long and 30 for the short, something like that.
All right, so you want to go out to, let's just pick August?
Okay, August, yeah, right.
And 164s, okay. And on the short side, you want to do a straight calendar, 585?
Yeah, let's do a straight calendar to start.
Okay. And expiration on the short side, what are you thinking?
30 to 60. Let's call it,
let's go 45, right in the middle.
Right.
Okay,
so that costs us $1,500
Mm-hmm.
You've got a chance to cover a little bit if it moves above on you. You get a little positive carry.
Mm-hmm. Yeah, so the positive carry, you can see it in this diagram because you get a standstill rate of return. And another way to illustrate that, so Mark, you go ahead, talk. I'm going to try to pull it up.
So the positive carry is always nice with options because the options kill you because of time decay, and a lot of times we get sort of stuck because we've got a trade. We do a long 30 or 60-day option. It goes against us a little bit of time decay, a little bit price against you, and all of a sudden you wake up and your option is down 50%, and you're going like, well, should I hold on for a rebound or should I just get out and take my lumps? That's if you're speculating to the downside. Now here's the hard part about this trade. If you're doing this for a hedge, you want to lose money on the hedge. That's the problem. It's like buying car insurance. You don't buy car insurance because you want to go out and wrap your tree around a telephone pole.
You wrap your tree around a telephone pole?
Wrap your car around a telephone pole. Yeah. So, so I couldn't decide which way I was going to run into. So
maybe both.
Yeah, so you're going to lose it, but if something kind of doesn't happen, it's kind of nice to know that you didn't pay much of an insurance premium. Say if after 30 days you broke even or something like that.
What's interesting is that as we look at August here, that vol is not up as much as I would have thought it would have been.
This is
so I want this is the August expiration. It's it's about 23 and change now, but before the conflagration that we saw, before the strikes, I mean, we're going back now to actually about last Christmas. It was 22.
Yeah,
and now it's nobody one vol click. Now, in fairness, as we think about it, this corresponds 3 months ago. That corresponds to something that would be 3 months further out. So that's going to be over here.
Mm-hmm.
But even so, right? That's not a huge difference. So those actually do seem they're pricier than they were.
It's not bad,
but they're not pricey, all things considered. So, yeah, I think that's another way one could potentially play it.
This reminds me. We started, at I guess it was CRT. We started, or maybe it was Dash, I don't remember. Looking at calendars a lot more often because we had so many clients that were. I don't know if you remember the one meeting we had. I think it was in Santa Monica. Somebody said, "Yeah, I've got a X billion-dollar portfolio, and when I do a hedge, I spend $4 million, and I expect to lose it all." And that's
Mm-hmm.
when we're talking about, well, how about if we can get you something similar protection, but instead of losing 5 million, you lose two or one and a
Mm-hmm.
half. And that's when we started to look at calendars a lot more often for hedges.
Yeah, and that also became, that gets touched on a little bit in the book as
Yeah.
well. But yeah, we were at CRT because yeah, for those who don't know, um, Mark and I both worked at a firm called CRT Capital. CRT stood for Credit Research and Trading. Was an East Coast based broker dealer that focused principally on fixed income, but we were brought in for a derivatives strategy on the equity side. And so, because the firm was mostly focused on fixed income, most of the relationships, we ended up going out to California, and out here a lot, especially in Southern California. A lot of the managers are former Drexel
Yeah.
guys. When Drexel Burnham, under Mike Milken's leadership, decided to relocate, um, I think a lot of people are aware that Drexel had, they ultimately went out of business because of some of the, alleged wrongdoing that was going on there. But a lot of those people were really smart guys. I mean, that was the place to work. I mean, I can remember when I was in college. This is when Drexel started to come undone. But the president of my fraternity, who was a very smart guy, summa cum laude, Phi Beta Kappa, math and economics, he had gotten an offer from Drexel to work in L.A., and that was the hot ticket at that time, to be in the junk bond business working for
Yeah.
Milken. But in any case, all of we often hear about the Tiger Cubs, which were all the hedge funds that spun out of Julian Robertson's operation. There were a lot of sort of those Drexel, I don't know what they call them, but the Drexel Cubs, if we will. All this spin-off operators that people that came out to work for Drexel, and when they came undone, they started their own shops and did their thing. So yeah, that was the context. Finwest, by the way, who's a regular viewer, thanks for coming back. I traded Chewy using bull put spreads several years past, but the technicals have been dismal lately. Absolutely agree with that. And the low share price doesn't offer a lot of option strikes, so it's off my watch list. Again, all good points.
Yeah.
And when I brought this up, I really was bringing it up because it's just on my radar. I don't have a position in Chewy, but I'm thinking about it because I'm wondering whether the 25th is going to be the catalyst. Maybe that is what gets things turned around. I kind of feel like if they report numbers that are vaguely in line with what the street's expectations are, that it's a very reasonably valued business, and it could attract some capital, and the technicals will start to stabilize. I completely support people who make it their process to say, I love the company in terms of its valuation if those numbers are real, but I am not going to buy it until it illustrates that there's some money flowing into
It's
it.
real stuff.
I absolutely agree with people having rule sets like this. But, my purpose in bringing it up and having conversations with folks like Mark about it is that sometimes we need to have things on our radar because we're just saying, look, I mean, this looks like something that could be, and you need to do that work now. Like, we don't want to get into the situation where suddenly this thing catches a bid and we're saying, oh, what is Chewy? Why should one care about this? Why is that stock suddenly turning around? I'm just looking at it and saying it seems like this is something that has a reasonable valuation, and if it starts to catch a bid, I think it's worth taking on the long side. And I think we're going to find out within the next 2 weeks, because I believe that the stock's probably going to respond if the news is at all like what consensus is on the 25th when they report. I think it's a pre-opening report, but we'll have time to look at that. Finwest also says, thanks for your cost business. Just closed my cost earnings trade today at my profit target, and we'll look at some bull put spreads soon. Costco is an interesting one because um, it had got, the valuation, I think at one time it got to like 60 times. And I was thinking, this is just,
Too
incredible.
much for retail.
But it had, it has come in a little bit in terms of its valuation, or it had as of the end of the year. Look at that. So it got down to 850, and that was. I remember looking at it and saying like, "Oh, 40 times. That's cheap for Costco."
It is.
I must have been, yeah. So I was looking at it this way, just so people can get a sense, is that I was looking at it. I like to look sort of at the next 12 months, and the way their fiscal year jogs, you sort of need to add up the quarters. So what I was doing was I was taking a look at the next 4 quarters, which was going to be these right here, and let's see, and we can do that same math again, but what we have is 4, and so that was almost $21 a share. Yeah, so that worked out to 40 spot 5 times earnings. It's a little pricier now, net of that rally that we've seen.
It's interesting.
Up 150
Costco's got a
bucks.
beta of 1, so that suggests that their cost of capital is about equal to the cost of capital of the S&P 500. What's interesting, if you go look at the company's EPS growth rate, where was it? I had a little chart here. Where'd it go?
I'm seeing, it's low double digits is what the street's looking for. It was a little less than that in 2025, but trailing 12 months, 11.3%. Fiscal year 2026 ended August, anticipated 14% year-on-year EPS growth.
Yeah. What I think is interesting is their growth rate for the past 10 years. It's been about 14% earnings per share growth rate. That exceeds their cost of capital. And their cost of capital is probably about 12%. So it explains why they trade at such a big premium, because people are extending that into the future. Even if we look at short term, last 3 years, EPS is up 12% compounded. That's on the backdrop of revenues being up 7% compounded. So they're expanding margins and things like that. So I think it's easy to justify the current valuation of the stock if you believe that they're going to continue to grow earnings at about 10% a year or more for the next, let's say, 4 or 5 years.
Well, Finwest is saying he intends to look at some bull put spreads in Costco. So it sounds to me like, on the basis of 2 things, the beta you just suggested, the fact that their EPS growth exceeds their cost of capital, it sounds to me like you think this is, and it's kind of a staple stock, you would probably be supportive of that. And actually, volatility just across the complex. I haven't checked Costco. Let's take a quick peek. Everything's higher, vol space wise. So I'm guessing they just had earnings, but where are we? If we take a look at the post, I'm going to look at 2 years worth of data. Let's go even more than that. Let's go 5 years worth of data and see how the current vol looks on a post-earnings basis. And if people are concerned about war, then it should be higher than it has been on average. And indeed, it does appear to be. Right? So all of these little humps that you see here, we know what those are. That's earnings, earnings, earnings. You can see it's, happening with a fairly regular cadence. Rest of the time, it's a little bit lower. And this is 1 month vol. So Finwest, it suggests that your strategy is not a bad one. Here again, I'm looking at 5 year. This is what you'd be selling if you're selling premium, and this is a 2 month option, so it's still going to be between earnings. So in theory, that's a reasonable approach like that. Finwest also asks, how do you think the numbers will be from Oracle tonight? I'm going to let you answer that.
Oh boy. People are going to focus on the CapEx number because their CapEx number has been enormous. I haven't looked at their debt lately, but I heard on, I think it was CNBC last night, that it's up to $100 billion now.
Yeah, more than $100 billion net on their last reported number.
They've gone a little
Big negative
nuts.
free cash
Larry
flow.
Ellison said that he had, I guess this was 6 months ago, he said on TV, he said his customers were begging him to expand capacity. So, he's throwing money at it.
Mhm.
People, I think, I have a hard time because this is a big bet, the size bet that they're making.
Mhm.
What is the enterprise value here? So what is debt as a
Almost a half a trillion, I think. It's more.
So it's a half a trillion and
Mm-hmm. 539 billion bucks. And over $100 billion in net debt.
yeah,
And they're going to be adding to that because they're looking at negative free cash flow of about 23.5 billion ish for next year.
Mm-hmm. Well, if that kind of is it, then maybe you could see yourself through to the other side. What makes me very nervous about the data center things is these servers last 3 to 5 years. And is there enough time to monetize the investments made, given that there's this mad race to make faster, more energy efficient chips? And are these data center build-outs, are they going to be under pressure in 2 or 3 years to change their servers to things that are more energy efficient? I don't know the answer to that question, but that's my fear for the industry. And it's also been my view, as I thought the industry is going to produce lousy returns, but within that, there's going to be 2 or 3 big winners, and then there's going to be a couple dozen people that just get crushed. And Oracle's likely to be one of the winners, but you can't say for sure.
Personally, I guess my question would be, this thing is trading 20 times. Let's see, what are they trading? Let's see what they are. They're trading 20 times the forward number ish.
Mm-hmm.
And that's about what Microsoft is trading, except that Microsoft still has positive free cash flow and no net debt.
Yeah.
I just find it difficult. Also, the momentum's not there. And actually, Finwest, to your point, because you're asking about Oracle, you're not looking at Chewy because it's technically dismal. I don't know that we can look at Oracle and suggest that it's any different. It looks pretty grim from a technical point of view to me as well. Maybe this is some kind of an important level here, but we are below every long-term moving average.
Yeah. In the data center business, I think the vulnerability that people aren't talking about is, there's a race to build the software, but how are they calibrating the software? Well, they're going and grabbing data off the internet. And so people have different models, and there'll be differences in the model, but more or less, there's this game of everybody's just ratcheting up. And I think the software is going to be the generic component to AI, and nobody's thinking about that. And it's going to be data. Are you going to have proprietary data in which to calibrate your models to make better decisions? If you're using AI to help run your business, I mean, that's sort of my thought. And companies like Oracle do have tons of data because they can use their customers' data. They can cloak it and hide it so that people can't see whose data it is, but it would be valuable data to calibrate models on if you're trying to figure out what's going on in the world.
Yeah.
Those are my thoughts, but I don't have any insight on what these numbers are going to be. But I sort of have some
Oracle
fear it's
is not
not
my
going to be good.
favorite.
My fear is it's not going to be good.
Yeah. Yeah, Oracle's not my favorite. Monetizing their investment is something that is pushed way, way out. I feel like there is less risk in. They're not. I mean, they're not exactly the same business, but there are other players that have exposure to this space that I think are better, safer investments. I would rather have my money in Microsoft than Oracle, for example, as a on the hyperscaler front.
Yeah, they have historically been very responsible with capital, and they seem to have gone off the reservation. But maybe they know something the rest of us don't know, and it'd be nice if they did, they'd share it with us.
All right. Well, I think with that, we have clipped everybody's day to the tune of about an hour, including yours, Mark. I know you have a long day, and you still have a long one in front of you. But yeah, if you have time for an office hours session next week, even though you are officially on vacation, you're not going down to Fort Lauderdale with all the kids from your classes. We'll try to do this next week. So for all of you watching, a subscribe would be much appreciated. Send us your questions. Perhaps Mark or I will write about some of those things and put it up on the Options Edge website or discuss it on a future office hours. So we look forward to reviewing your questions. Put them into the comment section for the video, though, not the chat of the video itself, because that we lose access to as soon as this completes, which it's going to do right now. Okay. Thanks, everybody, for watching.
See you later.
We'll see you soon.